Hey, good morning, Choice Residential. Hope your day's off to a great start. Today, we are diving into the market data for October 2024. So let's jump right in. I'm going to preface this with saying that Dorify MLS, because they have added additional market areas, including the Triad area, Lake Gaston area, so they've pulled in some additional data into their coverage area. We had to recalibrate the areas that we are looking at this data for because the total data that's now being pulled into Dorify is coming from a larger geographic area. Therefore, it kind of skews the numbers when comparing it to periods prior to those market areas coming in. So we are honing in our triangle market data on Wake County, Durham, Johnston, Orange, and Chatham. Those are the 5 counties that we are combining and looking at here and are comparing it to prior periods for those same 5 counties. So if any of the gross numbers look different relative to prior months, that's the reason. But just know that we are comparing apples to apples here. So we're taking this 5 county area for October 2024 and comparing that to that same area to prior periods. So with that, let's jump right in. New listings were up 14.4% year over year. So that's October 2024 compared to 2023. And you can see the gross numbers here in parentheses. Year to date, new listings are up 12.8%, so relatively in line with the growth we saw in October. Closed sales for this 5 county area up 11.7% in October, so that's great. That also represents what we saw here internally at Choice. We certainly saw closed transaction numbers going up year over year. So we were at 2,225 closings in this 5 county area in October. But keep in mind that year to date closings are still down 2.7% with just over 22,000 closings that we've seen in this 5 county area. A median sale price up 2.5%. So this is one of those numbers that looks different from prior months because we are consolidating to just this 5 county area so that we can keep it consistent moving forward. But the median price being just over $451,000. Year to date, that's up 2.3%. So that's really steady, I would say, on the low end of healthy growth for price appreciation. So it's good that we're seeing that. We're not seeing prices drop, but we're seeing a steady increase over the last 12 months. And then the percent of original list price received is 98.9%. So again, that may be, there are price reductions that happen, and then that at the reduced price, that listing may sell at the list price. But this takes a look at what the original price was compared to what they ultimately sell it for. And just a year ago, we were up closer to 100% at 99.6. So you can see there's a little more breathing room or a little more negotiating room as of October of this year. So just something to keep in mind. Looks like there still is, on average, some negotiating room, but of course it varies listing to listing. All right, let's take a look at inventory. So it's up 4%, and that is inventory at the end of any given month. So at the end of October, we had 5,657 homes for sale. Again, that's up year over year, 4%, which it's great that it's up, but it's still really low. And we'll get to that in just a minute. A month supply of inventory is at 2.5 months. That would still put you in a seller's market. Looking at a balanced market, generally to be somewhere between 3 and 6 months of inventory. And that's not too different from last year at this time, where we had 2.7 months of inventory. And so again, that's essentially how long would it take to sell the current inventory on the market if no new inventory was to come on. All right, so one of my favorite things to do is to compare where we are today with where we were the last time we were at a pre-COVID market. So if we consider pre-COVID to be, and I'm putting air quotes up, normal, then it's nice to look back to see where do we compare now to a quote unquote normal market. So we're going to look back at October of 2019. And you can see the inventory levels at the end of October in 2019, we had over 8,500 listings. And again, right now, at the end of October, we were at 5,600 listings. So roughly 3,000 listings short in just this 5 county area. A significant shortage of inventory, despite the fact that we look up here and we say, okay, inventory went up 14% in October. It's up almost 13% for the year. And yet we are still drastically below levels that we had in 2019. By the way, if you were selling real estate in 2019, you may remember that it felt like we had virtually no inventory back then. So even at these, even at the level that the difference that we're seeing right now, we're 3,000 listings short for inventory. Even if we were to recapture that, it would still be what probably is going to feel like a low inventory market. So it just gives you some perspective on how inventory has not recovered the way we were hoping. So if you see headlines for articles that talk about inventory spiking or inventory surging, put this in perspective when you're having conversations with people out there. We are still well below the 2019 levels, which were also low at that time. The month supply of inventory back in October of 2019 was just below 3 months of inventory. So still a seller's market, but approaching a more balanced market back then. Median sale price in October of 2019 was $295,000. So let's extrapolate that. And let's say that we had seen what I'm calling normal appreciation. So in a desirable market like we live in the Triangle, home price appreciation is typically going to outpace inflation. And so let's just assume that we had a 5.5% appreciation rate if that was a healthy growth for real estate in the Triangle. If we had had that growth for the last 5 years, then the median price today would be at about $385,000. Keep in mind, our median price right now in these 5 counties is $451,000. So we are still well ahead of where we would have been if we had just seen kind of straight lined normal appreciation in our market and didn't have the run up that we saw in 2020 and 2021. If you were to continue extrapolating this out, it would actually take another 3 years of flat price growth. So if year to date we're up 2.3%, but if over the next 3 years we saw zero price growth on the median sales price, that would land us to where the straight line appreciation at 5.5%, that would equal about $450,000. So I think it's just important to have this perspective that when we look in a minute at housing affordability and the factors that impact that, you can see how the run up we had during the COVID appreciation spikes, we still haven't caught up to where we would have been without that. So prices are still elevated in that sense. Normal appreciation would have gotten us to about 385. So just keep that in mind for some perspective. New listings coming on the market in 2019 was 3,300. We only had 2,800 coming on this October. And then closed sales were just under 3,000 in October, and we had just over 2,200. So significant difference. So even though they were up almost 12% in October from last year, you can consider how much below they were the levels that we saw in 2019. And of course, our population is certainly greater today than it was 5 years ago. If you look at year to date back in 2019, just to give you some kind of larger numbers to think about, we were at 29,500 closings for the year. And again, this year, we're at about 22,000. So almost 7,500 fewer closings have happened in these 5 counties this year, which is why for some agents, you experience pipelines that may seem dry, number of transactions you've had this year are down. And that's because simply the market is significantly down where we were in more normal years, such as 2019. All right, let's keep going and take a look at a few other data points I'd like to point out to you. I just like to show you kind of the trends here. So seeing inventory levels in October as a standalone number, it doesn't always give you a ton of perspective. So we just compared it back to 2019, but I want you to see what it looks like throughout the course of the year. So generally what we'll see in a quote normal market is inventory levels bottom out in December, and then they will start to climb in January, usually topping out somewhere in the summer months. So maybe between June and August. Then they will start to fall again through the end of the year. That's kind of the normal bell curve type of shape that you can expect with inventory levels. We haven't seen this year separately from prior, the last couple of years. This is a little more normal, but I'll just point out here, we started off the year with 4,100 homes. We saw a really slight increase, and then we actually saw a drop off in March. But then we resumed what would be a normal trend, which is to see inventory climb in April and May and June. Then we would usually see it peak somewhere again in June, July, or August. As we got to August, it has kind of flatlined here, up a little bit in September, and then just up marginally in October as well. So we'll continue to watch what the rest of the year looks like. Generally, we would like to see inventory actually dropping. That would be the typical trend we would see. But because we're so low in inventory, of course, we as agents are all out there hoping for more inventory so that we can find homes for our buyer clients. So we'll continue watching that. All right, one data point I like to look at is the new listings to closings ratio. And what this tells you is how many listings do you need to take in order to sell one home. So again, we go back to the Great Recession and you can see that you had to take two listings, actually more than two listings in order to sell one. That means 50% or more of the homes that were listed were not going to sell. And then we saw that ratio improve as we got through kind of the post-recession period. Then into the COVID market, it got down to where basically every single home that was listed was going to sell. And then we've seen a kind of a more typical market appear as we've come out of the spike of COVID. And we see that this year we're year to date at 1.33. And so that's a perfect ratio to show that for every 4 homes that get listed, 3 are going to sell. Again, this kind of gives you an idea of what the experience is like for sellers out there. And the closer to 1, the more of a dramatic shortage of inventory and multiple offer scenarios we're going to see. The further away it gets from 1, you could see longer days on market. So I would say right now, 1.33 is pretty healthy. This number has been coming down throughout the course of the year as well. So we'll see where it ends as we get to December. But I would think that we'll be somewhere between where it is now and what we saw last year. So wouldn't be surprised if we're somewhere between 1.25, which would mean list 5 houses to sell 4, and 1.3. So I think this is about what we'll see as we approach the end of the year. All right, and then the last thing I want to show you is the Housing Affordability Index, and I've got this run back through all the way through January of 2023 over here on the left, and then through current October of 2024. Really not a lot of movement here. I mean, there are some ups and downs throughout the various months. In the summer months, we see that the ratio, the Housing Affordability Index, goes down. That's often because prices are going up. Usually that time of the year represents the highest seasonal prices that we're going to see. And so if mortgage rates are staying relatively flat, then of course affordability is coming down. And then we can see that change as we get into the fourth quarter. And you can see that same kind of trend here, where in the spring and summer months, it was a little bit lower. And then we've seen it climb some as we have approached the fourth quarter. Keep in mind, 100, an affordability index of 100 means that the median income can afford the median home. For example, in October, it was 75. That means that the median income is only 75% of what you would need to afford the median home. And for some perspective here, in October of 2019, the affordability index was 140. So that means that the people were making 140% of the median income needed to afford the median priced home. So this has a lot to do with house prices and mortgage rates. And then, of course, incomes and wages play a factor as well. But if you were to look at a chart that tracks mortgage rates and the housing affordability index on the same graph, you'll see this inverse relationship that as mortgage rates have gone up, then you'll see parallel with that housing affordability goes down. So one of the key factors we're going to need to see, even probably more important than price moderation, is mortgage rates to come down. We're unlikely to see any significant drop in house prices. So if we can keep pretty muted house growth, so 2 to 3% a year in terms of housing prices, that would be very healthy as long as we can get mortgage rates to come down. So that's something we will continue to monitor. So hopefully these data points were helpful for you. I'm happy to chat further. If you ever have questions, let me know. And if you have comments or other things you'd like to hear me talk about in future market updates, please put them in the comments below, and we'll see if we can't tackle that for you with the November market update. So that's all I got for you today. I hope you have a fantastic day.